You're listening to the Accelerator Network Show.
Hello, everyone. Welcome to the Accelerator Network, the live show where we bring you the current economic news and more. Today, we're going to be talking about the incoming solvency crisis. Cash flow will be everything in the next decade. And this is an opinion piece. Depending on how things go when we get back to work, maybe none of this is true. But let's look into this. We're looking at a three-phase event here, and this comes from Raoul Paul of Real Vision. Right now, we're in the hope phase, but first there was the slowdown phase, where things were already slowing down. There was a massive deleveraging by the Fed in 2018 that eventually turned into more quantitative easing because the stock market crashed towards the end of 2018. And you can actually see they started to deleverage right here. As it deleveraged, they suddenly, right in September, had to bring back their quantitative easing after rolling all those assets off the balance sheet because the stock market just started to tank towards the end of 2018. And you can see the money printing that's happened right here during this time frame, and it's absolutely astronomical. So in September of 2019, the repo market explosion happened behind the scenes, and this really started the financial crisis that nobody really was talking about at the time because it was behind the scenes. There's also a trade war going on, and now we have oil price collapsing due to an oil war going on. And the virus has just sped all these processes up. So the slowing down has been sped up by the virus. Liquidation phase. This was in March. There was a market crash of 20% in March of 2020, which is just a few months ago. And then we have the hope phase, and that's where we're in right now. Markets are rebounding, and as we gain an understanding of this situation, and we need to know right now what it looks like to go back to work and how the economy is going to react to this. Now, what I'm going to be talking about is a liquidity event versus a solvency event. What happens during a liquidity event is there's no access to capital, the bond market freezes up, companies and households run out of money, and the Fed comes in and just gives everyone money. And we've kind of seen that happen. What happens during a solvency event is there's no access to cash flows. So the market is slowing down. Businesses aren't selling as much. There's not as much services going on. People aren't shopping and spending money. And a household example would be the only way to pay your mortgage or rent is if you have an income. If you don't have an income or your income is less than your mortgage, you'll default on your mortgage. And in a liquidity event, even if someone is lending you money, all the Fed can really do, you still can't pay your debts because you don't have the cash flows to pay them. And the same goes for businesses, big and small. We have a record amount of debt at the corporate and house level in the United States, and we're coming into a slow economic growth period. The Fed can't really solve this issue, and you're not going to borrow more money to solve this issue. It's just not a way out of it. So what just happened? We slipped into a negative GDP over the past few months. People and businesses just stopped spending money like normal. And the Fed's response has just been, you can have some income, you can have some income, you can have some income, you get a bailout, you get a bailout. And, what happens if the economy is slow for the next 3 months from now? Well, the Fed's response, the only response they have is you can have some income, you can have some income, you can have some income, you get a bailout. What happens for 3 months after that? Well, the Fed's response is going to be, we don't have enough money to give you money because this and that. And we're already seeing that happen. It just becomes very difficult politically to just keep giving away cash flow to individuals and businesses. And, really, the Fed's job is to let the economy slowly drop. They don't want to have it crash, fail, because things will break along the way. But if they allow it to just have a soft landing, that's what their job is, and that's what they're going to do. So, bond yields appear to be going to zero, and this is not good because a lot of people rely on bond yields and fixed income as their retirement income. And this is bad for young and old seeking prosperity. For the millennials, they will lose faith in the whole system. and you can only be burned so many times. Millennials have been burned by student loans, car loans, credit cards, and they're still renting homes and apartments. They haven't actually entered into the house market as home buyers. Baby boomers bond yields are going to zero, like I just said. Fixed income earners will see a haircut. You'll see haircuts off of pensions. Retirees will be wondering if they can have enough saved to last them throughout their entire in retirement. Saving to draw from 401k in a falling stock market, millennials will no longer be propping up the market, so baby boomers will start to pull money out. And due to the loss of faith in the entire system, millennials will no longer be propping up that market that money is being pulled out of. Stock buybacks will no longer be propping up the market. Companies will need all cash flow to service the debt and pay the workers. So we're going to be in a period of extreme deflation coming up. Not only are the currencies falling down a well right now because of the mass money printing, commodities are falling even faster. The dollar is everything, and it's the modern day gold standard. So the dollar is about to become very powerful. People are going to need dollars to service their debts. They're going to need dollars to, pay their employees, pay their workers, but mostly service the debts around the world. So let's get into the economic news today. It's May 14th, 2020. Unemployment claims came out today at 36.5 million. Approximately 20% of the U.S. workforce is now unemployed. Additional 3 million Americans were filed for employment in the last week. Retail and office building, commercial real estate is suffering immensely right now. Malls are simply still empty despite the reopening. Strong tenants are starting to negotiate leases down. So you see places like Starbucks saying, hey, we want a discount because all the businesses around us aren't even paying and we're still here making money. We want a discount. So commercial real estate loans have not changed despite the cash flow crunch. Many haircuts are coming to commercial bank balance sheets. So look for that coming down the road. More companies coming out saying that their employees can work from home forever. More people will be moving out of the expensive, overtaxed, overpriced areas. And the WHO reports that this situation will be a 5-year-long journey. WHO claims there will be no immediate vaccine on the horizon, and it almost seems like the WHO is working against us. In the Spanish flu, they had masks, hand washing, social distancing, and it all went away within 2 years. And I think we're going to have the same type of situation here. All right, guys, thanks for watching. If you found this information useful, please like and subscribe and post a comment below, and I will see you in the next episode.